We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Adrian Day, CEO of Adrian Day Asset Management and manager of Euro Pacific Gold Fund. Thanks for coming back, Adrian.
Well, thanks, Tom, very much for having me. I enjoy your interviews.
Oh, thank you very much. And, of course, it's been a little while since you and I have spoken, and I keep meaning to make the time to circle back with you. But before we hit record today, you and I were discussing the lags with which the monetary policy really ends up affecting all of the different markets and all of these different moving pieces that we need to be looking at. The bank failures, for example, are something that has manifested as maybe an issue from the fastest rate hiking cycle that we've seen. So maybe we can start there, talking a little bit about the lags and the expectation of the market that doesn't necessarily match what is yet to come as a consequence of this rate hiking schedule.
Well, those are huge questions, and I'll look at them separately if I may. The first one is on the lags. Yeah, I think everybody has heard, Milton Friedman famously said monetary policy works with long and variable lags. And Jerome Powell, Fed chairman himself, I don't think it was this meeting, but the meeting before, he made reference to that. I think it's important that people really understand just how long these lags in monetary policy can be. The length is one thing, but the variability is the other thing, because some sectors, such as housing, automobiles, they're very interest rate sensitive. And so they respond very quickly. And we saw that the Fed's now been raising rates since last April. And we saw that within a couple of months, you saw housing and automobiles affected. But other things, it takes longer, much longer. And what I would say is, I think it's important that people understand that even if the Fed were to pause right now and not raise rates again, even perhaps reduce rates a little bit, the economic impact of what they've already done has yet to be felt. And as you said, this is the fastest, the most rapid, the most aggressive interest rate hiking cycle in history, even more so than Volcker. And I take nothing away from Volcker, but let's not forget when Volcker was appointed chairman, the Fed funds rate was already in double digits. What the Fed has done is gone from 0, lower bound, to 4.5, which is in less than a year, which is dramatic. I'll give a couple of examples of the variable lag. So, how the headlines can give a misleading impression of what's going on in the economy. You look at consumer spending, for example. Consumer spending last year was actually up a little bit. And that was grist for the mill for the apologists, the Fed apologists and people who thought the economy was doing well. Now, I'll say two things about that. First of all, if consumer spending is up a couple of percent, but prices are up 8 to 10%, that already in itself means that consumers are cutting back in some way or another. Mm-hmm. So the dollar volume of consumer spending may be up, but the volume of goods that were bought is down. That's the first thing I'd say. The second thing is, yes, consumers have continued.
For 1 sec, Adrian, could that not also be an artifact of the base effect or the comparison to the previous year when, people were in lockdown, really?
Of course, yes. I mean, when we came out of lockdown, spending patterns during lockdown were different than they had been before. And when we came out of lockdown, then spending patterns changed again. That's why restaurants and airlines were full for so long. And everybody was saying, look, everything's fine. Look at the restaurants, they're full, everything's fine. But people had been locked up for a while and now wanted to go out. But the other thing I'd say, you look at the headline about consumer spending up, but look at it in a personal way. What happens? You've got a family, prices are going up. The wife doesn't immediately say, I'm not going to buy, the Snap Crackle Pop for the kids anymore. You continue to buy that, and the couple uses what's in the bank account and draws down savings. First of all, you saw that in the US very much. Savings rate collapsed, and the absolute level of savings went back to before COVID. Then when your savings have gone, what's the next thing you do? Well, you don't pay off the credit card, and the credit card balances start to go up. That's what we saw in December, January, February, high levels of credit card balances. And then the last effect, of course, is your savings are gone, you're maxed out on the credit cards. God forbid one of the two, husband or wife, loses a job. But even without that, you're maxed out, and then the credit card defaults start to increase. And we've seen that. What I'm saying is that the headline saying consumer spending is good, that continues throughout all those underlying problems. And it only starts to decline, and we're at that point now, it only starts to decline when people start to lose jobs and the credit cards are cancelled or or defaulted on. So that's just one example of the variable lags that you see, and it gives a distorted picture of what's going out. And I won't talk so long on this, but the other obvious one is companies who took out loans. Mm-hmm. Well, all those loans were not due, in April of last year. So as time moves on, more and more companies have to refinance at higher rates of interest. And particularly if you're small businesses are the ones that are most affected by this. Large companies have tended in this environment. Large companies have tended to max out their debt, so that by and large, for the big companies, for the S&P 500, you don't really get much in the way of maturities until the second half of 2025, and even 26 and 27 is when you get more. But for smaller companies who've maybe borrowed money but have to reset the interest rate every year, perhaps, or they couldn't borrow for so long, for a smaller company where high yield rates, right, were actually under 4% a year ago. To borrow money, let's say they were borrowing at LIBOR plus, they were borrowing at 7 or 8%. Now they have to refinance at 12%. That is a huge difference. And it's no coincidence that just in the latest numbers of business bankruptcies in the United States that came out yesterday, I can't remember the numbers, so excuse me, but it was something like last year, you had an average month by month, you had an average of about 30,000 businesses. The max was 38 in any one month. And last month, it was 72. So you've had a huge increase in bankruptcies. Most of those are small businesses, but we see it everywhere. You walk down the street and you see businesses go out, companies go out of business. So yes, I think there's a lot more damage in the economy ahead. That's built in. It's already baked in, and the market is not seeing that.
Is it possible? As you just said, the market is not seeing that. When we think about forward guidance and the idea that the revenues that are projected for, let's say, most of the companies in the S&P, do you think that is still not being understood by the market of how that refinancing affects those companies?
Oh, absolutely. I mean, the current consensus estimate for S&P earnings, sorry, let me say that again. The current analyst consensus estimates for S&P earnings for 12 months going forward is down just barely over 1% over what the last 12 months was. Given that the last 12 months was still getting the effect of a rebound from post-COVID, but forget that for a second, to think that we're heading into a recession and inflation is still persistent, which means companies' costs are continuing to go up while demand for their products are going down. To think in that environment, S&P earnings are going to decline by 1%, I think is fantasy. I think it's total fantasy. But that's what the market has priced in. The market has priced in an average of 74 basis points. That's the average on the Fed funds futures rate. Fed funds futures rate is pricing in 74 basis points decline in interest rates from where we are right now. I'm not saying that can't happen. If we have another crisis, it could happen, but I think it's not pricing in the risk, but it doesn't happen. So yeah, I think the market is very optimistic right now.
Mm-hmm. Of course, Adrian, we saw the bank failures recently, and I just want to get your take on or sense of if you think that we're headed for more trouble in the banking sector, and or where you think these lagging and variable effects might manifest themselves, if not in more bank failures.
Yeah, I mean, I think it would be foolhardy to think that those three US banks, and the first one, what was it called? I forget.
SVB, yeah.
There was CVB Signature and something else.
Right.
But everyone's forgotten about the third one. But to think that those three banks, plus Credit Suisse internationally, were the only banks that are on the edge right now, I think is foolhardy. So I think we're certainly going to see more problems in the banking sector, but also other financial institutions that had the same problem. The problem of basically having to stretch for yield to meet their obligations. Banks were not generating enough, so they had to stretch for yield. And banks, of course, had a huge mismatch between deposits and assets and liabilities, which, I would have thought that was number one rule of banking. Match your assets and liabilities in terms of duration. Mm-hmm. But because that means if you don't, you're very vulnerable to a bank run, as we saw with SVB, very vulnerable. But other financial institutions, which have the same sort of issues of having to earn X amount on their deposits in order to meet their obligations, for example, pension funds, for example, insurance companies. Pension funds in the US have to earn about 7.5% to 8% a year to pay their obligations. Well, over the last 10 years, you couldn't earn that in the bond market. You simply could not earn it by buying long-term, high-quality bonds. So what did they do? They did what, the little old lady living on Social Security and her bank account has done. You stretch for yield, which is very dangerous. And that means leverage. That was the problem in England, of course. The pension funds had leveraged. I mean, the idea that a pension fund is going to use high levels of leverage in order to meet their obligations is just the most imprudent thing imaginable. So I think you've got problems in pension funds, insurance companies, as well as other institutions.
So you bring up a good point about let's say the traditional index fund investment strategy or the barbell approach of stocks and bonds. Do you think that this new rate cycle has, really destroyed that traditional approach?
Oh, absolutely. Bonds have always worked with very long cycles. The cycles in bonds are long. So you think that this bond market, the bond bull market, began in 1980, didn't end until last year. It had a few ups and downs, of course, but looking back on it, that was one long cycle. And the cycle before that started in the 50s. So you had these long, very long cycles in bonds, much longer than stocks, much longer than gold, much longer than the economy. So I think we bottomed. It's an open question, of course, how high rates go, meaning how high bonds will decline. But I hope we're not going back to the zero interest rates and negative interest rates that we saw, in the last decade, which means that bonds have bottomed, which means that for most investors, you don't want to be buying bonds. You don't want to be buying and holding bonds for an investment. So you might, if you want income, you might want to do a laddered approach so that you have some maturing every year and you get the impact of the higher rates. Some people might want to trade them. I'm not a fixed income investor. I've never been good at trading bonds. But you don't want to be buying and holding for 10 or 20 years because you're going to lose money. The cycle has changed. And so you need to look at other places for yield. We can talk about that if you want, because, I have some favorite places for yield, but you need to look at other places for yield. But certainly bonds are not the place to go anymore.
So, Adrian, let's dive into that a little bit. When we're thinking about yield, are there specific places that you're looking at, or is it, I've heard you say that dividends don't lie. Are you looking at dividend strategies as well?
Yeah. The quote I like, rather than dividends don't lie, is a quote I got from my good friend Doug Casey, and it's a quote from the Catholic Catechism. The question is, what is the sacrament? And the answer is, it's an outward sign of inward grace. And Doug says a dividend is an outward sign of inward grace. And I love that. Because over time, you can't pay dividends if you're not earning them. There's a point at which you can't do that anymore. Yeah, so there's three places where we're trying to look at income right now. The first one is mostly for American investors. There's a sector in the US, a sector called the Business Development Company. Business development companies are companies that lend money to small and medium-sized businesses, private businesses. That sounds very risky. I'll get into that in a second. But they're structured so that they don't have to pay tax at the corporate level, like real estate trusts. They don't pay tax at the corporate level. They distribute all of their net income to investors, which means the yields tend to be very high. Now, there's concern about this sector right now, both because of concern about the economy moving into a recession, which means maybe some of the companies they lend money to will default. And then the second thing is when you had the banking crisis, the stocks really came off because the banks were sold and any kind of financial company was sold off. I think there's a huge difference between the banks and the BDCs. First of all, BDCs are not leveraged the way banks are. I mean, again, for banks to be leveraged 7 and 8 and 9% is very imprudent to me. They should be the most solid conservative institutions out there, but they're not. So BDCs by law are limited to 2-to-1 leverage, and most of the ones that I follow have leverage much below that, like 1.2 or 1.3. Mm-hmm. So the leverage is very, very low. The second thing we touched on earlier, the good BDCs all match their loans to their debt. So the duration is matched, and that's a critical factor. So the truth is, I think the sell-off in the BDCs has been vastly overdone. And most of the good BDCs will all have workout groups. So that if a company they've lent money to gets into trouble, they have people, experts, turnaround experts, who can go in and help the company, and if need be, actually get rid of the manager, the CEO, but go in and help the company turn things around. So these BDCs have an extremely good record at low defaults. Like right now, Ares Capital, which is the largest of the BDCs, their default at cost, not at market, their default rate at cost is about 1.5%, which is significantly below any bank that's doing any lending. Mm-hmm. But secondly, they have a very good record at bringing companies that are on non-accrual. It's not really default, they call it non-accrual, but are on non-accrual. They have a very good record at bringing those back. So the companies that I follow, I can't give you a precise number, but just listening to the quarterly calls every year, every quarter for half a dozen of these companies, they'll say, well, we have one new company on non-accrual, but another one came back on accrual and they're paying us back what they owe us. They have a very good record of that. So I'm not concerned about that. And just to get your listeners a little bit excited, if I may, something like Ares Capital, I mentioned Ares, which is the largest of the BDCs, and arguably the most conservative. That's yielding 11% right now, 10.75%, fully covered by the net income, which is the metric you use for these things. Mm-hmm. Fully covered by their net income. So I think this is a wonderful place to find some income. I will just caution or note that the stocks are exceptionally volatile on a very short and on a longer term basis. The stocks can be very volatile. So Ares, which I mentioned in the last 6 months, has gone from 17 to 21, back to 17, up to 20, back to 18. They're very, very volatile. Mm-hmm. But so long as if you're buying for income, and so long as the dividend continues to be paid, I don't get too worried about the volatility in the stock price. Two other things I'll be quick on. One is just looking at global equities for income. And, the U.S. market right now, I haven't actually looked this morning, but the yield is, less than 2% on the S&P. Oh, it didn't. 1.6% is the dividend yield on the S&P 500. Now, that's because a lot of them are tech stocks, unicorns that don't earn money, so don't pay dividends. But nonetheless, if you bought the index, you'll be getting 1.6%. Many markets overseas have dividend yields that are 2 and even 3 times that high. And that's the market, not individual stocks. So I think a very good place to look are high quality dividend-paying stocks in Britain, in Switzerland, in Singapore, Hong Kong, where you can get some very nice dividends, maybe 4, 5, even 6%. And then the third thing we're doing for income, which is, extremely profitable, but you have to stay on top of it, and that's selling puts. I'm assuming your listeners know about selling puts. When you sell a put, you have the obligation to buy it if it's put to you. If the stock declines under your strike price, it'll be put to you. You have the obligation to buy it. So I only ever sell puts on stocks that I want to own anyway. I never sell a put if I don't want to own the stock. So we're looking at companies that we don't mind buying, owning. You look at when the stock price is down, but equally when it's been volatile in the recent past. So the stocks that are very volatile will tend to have higher premiums. In other words, they pay you better. And may I just to give an example, I don't know a good example to use right now. Let's use UNG, which is the index of natural gas in the US. So maybe not the best example, but that's $6.66 right now, $6.66. I hope this is a good one. I didn't look at this before the interview, sorry. And so you can sell a May, which is only 6 weeks away. You can sell a May 6, which is 10% under the stock price. So you've got a bit of a cushion there. And you get 44 cents for that. So you're getting 8% in 6 weeks for selling a put on UNG. And of course, the risk is it gets put to you. So you don't sell a put unless you don't mind owning the stock or at least renting the stock, as they say. But, if you're watching, there are some, I've seen instances where you can get 8 or 10% in 1 month. This is in 6 weeks. It's not unusual at all. Again, you look for stocks that are down, but you also look for stocks that are volatile. Because the more volatile they are, the higher the premiums. Remember, every time you sell a put, there's someone else who bought a put. And he's buying a put to protect his downside.
Right.
So the person who wants to protect his downside is more willing to pay more on a volatile stock. Right? Obviously, if you're selling a put on Treasury bill, you're not going to get much because they're not volatile enough. So those are 3 areas that we look for income.
Adrian, are you also looking at, let's say, energy stocks that are paying a really high yield, just simply, due to, let's say, where they're located jurisdictionally or because of the high profits that they do have?
Yes, I am. You asked if I'm looking at them. I'm definitely looking at them. I'll be honest, I had no idea OPEC was going to do what it did. And obviously we've seen the price of oil go up. I don't know what the percent is, but, we've seen it go up from like 65 to 80, 83 right now in a month, less than a month. And I was not expecting that at all. And to be honest with you, I thought we would get further weakness in oil based on a declining economy. So I missed out on that. But yeah, there's some good opportunities there as well. The real key, obviously, as you know, is you've got to look at a company when you're looking at an above market rate, market yield, you've got to look at why are they paying an above yield. And so long as they're earning that yield and the earnings are not, exceptionally high 1 year, but so long as they're earning the yield, and obviously you make an assessment that they can continue to earn the yield, I think oil companies are a great place to look right now.
Adrian, it makes me wonder how you see, let's say, the shape of the world economy going forward. If we see a type of global recession, how do you see that affecting things like energy stocks?
Yeah, no, that's an excellent question because, obviously you've got to stand back and say, every time you look at anything, gold, there's always positive factors and bearish factors. And who was it? Was it Benjamin Franklin or was it Warren Buffett? Or I don't know, not to conflate those two. But, somebody said he gets out a piece of paper and he actually writes down everything he can think of that's bullish and everything he can think of that's bearish. And he gives a weight to them. He puts them in order, which are long odds and which are more likely. And then he simply goes through, this is a 50% chance of happening positive. He crosses it out against his 50% bearish. And he's left with a list, but might be 1 or 2 things at the bottom that are either bullish or bearish. So every time you look at anything, there's bearish factors, bullish factors. Right now, I think there's little doubt that the US is heading into a recession. I don't know how deep it will be. It may not be very deep, but it is heading into a recession. Europe, I think, is heading into a recession. UK, Britain is heading into a recession. But there are bright spots around the world. China obviously has just reopened. And China not only is a source of a lot of supply, no good having supply if Britain and if America and Europe aren't buying, but there's also a big source of demand for commodities, right? So the Chinese economy opening, and China's the second largest economy in the world, is a very, very significant factor that can offset a lot of the negatives. On balance, on balance, I tend to think that the global economy will slow, maybe to the point of almost zero growth for the next 18 months. The US will be in a recession. I think Europe and UK are moving into recession. So that's obviously a huge negative for things like oil, and so then and other commodities. So then you have to look at, well, what are the offsetting factors? You know, first of all, if China's the bright spot economically, what are the things that China has to import that will? What are the commodities where China has a big demand and will continue to have a big demand? And then what are the offsetting factors on the other side of the equation, supply, that might keep things in balance? So you look at something like copper, for example. If the global economy goes into a recession, a lot of copper supply, a lot of copper demand rather, will go down dramatically, right? Because for all the reasons we know. But then you look at other sources of copper demand, right, which is electrification. You look at the copper demand from China, which continues to be very strong, and you look at the lack of increase in supply of copper, and on balance, you can come to a conclusion that copper is probably not going to be too weak over the next year or two, even if we have a global slowdown. And 3 to 5 years from now, I would say copper is going to be remarkably strong. So yeah, oil is definitely going to be affected by a slowing in the global economy. But again, China imports a lot, and you do have that difficult factor of OPEC, which can manipulate the market, you know, if they want. So I'm not a huge bull on the oil price for the next year, but I don't see it declining too much at the moment.
Is the electrification of the world something that you're still looking at and investing for right now as well, Adrian? Or do you think that the global slowdown really gets in the way of that as well?
Yeah, well, yes to the second question, but yes to the first question. You know, clearly, if the global economy starts slowing, there's people are going to prefer heating and food to, you know, saving the planet, to put it crudely. So definitely a slowing global economy means that some of the nice ESG targets that people have, the electrification targets, maybe slows a little bit. But, you know, electrification is sort of underway, and it's got its own momentum at the moment. And as we all know, you know, it takes much more copper, nickel, and of course battery metals, both for EV vehicles over internal combustion engines, and also for things like wind farms and solar, take a lot more metals than fossil fuels. So the demand will continue to be very, very strong, I think. And at the same time, with some of these commodities, the battery metals as well as copper, in particular, you have difficulty in increasing the supply. So, you know, I'm quite bullish on those things. Copper, we own, you know, I think obviously Freeport is the biggest of the publicly traded copper companies, and it's a great company. It's got diversified assets, world-class assets, great balance sheet, great management. So the fortunate thing with copper is you can get exposure to the biggest, but also to arguably the best, certainly the best of the big producers. And I would just look for opportunities to buy copper to buy Freeport. With lithium, I am not, and again, every time you miss something, you tend to rationalize, you know, why it wasn't a good idea anyway. But with lithium and the other battery metals, I am not buying lithium producers, the pure lithium producers or the pure lithium explorers, because I do think the price of lithium is vulnerable in the near term. But we're getting exposure. We're getting exposure through companies that have lithium as part of their portfolio. Mm-hmm. So a company like Altius, for example, Altius Royalties, which is a great company, which I love anyway, great management, great balance sheet, very well diversified, but they have exposure to lithium through an interest in a lithium company they spun off, and royalties on some of their projects. We're getting exposure to lithium through a company like Midland, which is again an exploration company, which I love, gold, copper, base metals, all base metals, but they've also got a lot of land that is very strategically located for lithium. So, the potential that they have a discovery is high, but if they don't, it doesn't destroy your reason for owning the company.
Mm-hmm. Do you tend to try to, let's say, balance risk of jurisdiction by having or holding companies that are diversified from a geographic perspective?
Yeah, no, good question. I mean, I tend to be more with the commodities. I tend to be a lot more cautious on geopolitical risk than a lot of my friends. Less so in my global portfolios. But for commodities, my sort of thesis is, or my thinking is, you're taking enough risk anyway, metallurgical risk, and you're taking commodity price risk. You're taking a lot of risk anyway. Why just add the risk of buying assets in Sudan? So there's two ways to do that, obviously. One is to have companies where most of our assets are in the solid jurisdictions, and we know what those are. And the other one is to have, it sounds perverse, but to have a company who's got high political risk, but the political risk is diversified. So like Barrick, in Papua New Guinea and in Congo and in Saudi Arabia and all sorts of wonderful places, but at least that political risk is diversified. Yeah.
Interesting.
The biggest risk with commodities, as we know, is all the capital is spent up front before the company earns its first penny.
Right.
And yet the asset is where it is. You can't pick up the gold mine or the copper mine and move it somewhere safer. Mm-hmm. And so mines become a very attractive target for rapacious governments. And we just saw that with Panama. Panama is hardly third world and is trying to project an image of being a financial center. But we just saw that in Panama with First Quantum. So governments, once the money's been spent on First Quantum's investment in Panama is, in today's dollars, the largest investment ever in Panama, exceeding even the building of the Panama Canal in today's dollars. Mm-hmm. But it's a significant investment. Once the investment's made, the government decides maybe we want a little bit more.
Mm-hmm. Yeah, it seems like a massive risk in this changing landscape that needs to be considered, because it seems like all the cards are on the table at this point.
Yeah. And I mean, there's no place that's totally immune. We saw it in Alberta. And then, of course, you have the other side of it, the permitting, which is just getting longer and longer and longer, mm-hmm. and more difficult in many jurisdictions, including Nevada. Who would have thought? So, even the good jurisdictions have their own risks. But at least I think if you're in Canada or in the United States or in Australia, you're not going to get the mine confiscated, but you're not going to get the mine confiscated. Mm-hmm. And so I prefer to have most of my assets in those countries.
Adrian, I want to get back to talking a little bit about gold. Of course, most of our listeners are very interested in the topics around gold, but I want to get your take on what actually moves the price of gold and how most people think that inflation moves it. And should we maybe be looking towards the moves of the central banks rather than just relying on inflation?
Yeah, no, that's a really good question. And I think you've answered the own question. I think that's absolutely correct. You can have periods when inflation is relatively high and moving up, and yet gold is lagging, because the market thinks that the central banks will come in and tighten, and tightening, of course, being bad. You also have the converse where inflation can start to go down, but gold does very well because the market thinks now the central banks will loosen. So it's really, I would say, it's the market expectation on central banks' monetary policy that is the biggest determinant. Mm-hmm. And you saw and on that theme, if you're going to control inflation by interest rates, right? If you're going to control inflation by interest rates, you have to get interest rates above the rate of inflation. You have to. Nobody disagrees with that. No reputable economist. Maybe Paul Krugman doesn't agree. I don't know. He disagrees with everything. But nobody disagrees with that. Now, you might disagree and say, well, the rate of inflation is coming down anyway, so we don't have to worry about it too much. You might say that. But nobody disagrees the rates have to go above inflation. And where we are right now, certainly in the US, I can't speak to Canada, I'm sorry, but certainly in the US, even with today's lower CPI number, you've still got 5% and rates are 4.5%. So we're still lagging inflation. You've still got a negative real return. You can't control inflation by interest rates unless you get above the rate of inflation. And a perfect example of that is the 1970s. Fed Chairman Arthur Burns, poor Mr. Burns, or Dr. Burns, I should say, poor Dr. Burns. Everybody says, I don't want to be another Arthur Burns. I don't want to be remembered like Arthur Burns. But they forget that in the 1970s, 1975 onwards, Arthur Burns was raising rates every single quarter. Every single quarter, rates were going up. And when he exited, we had double-digit rates, Fed funds rate. The problem was that he was lagging inflation the whole way up. Mm-hmm. And the market had no confidence that he would get above inflation and control it. When Volcker came in, the market immediately believed Volcker when he said, I'm going to kill inflation, and it means a recession. He said it means a recession. Mm-hmm. And the market believed him. And of course, rates went up to almost 20%, and we got above the rate of inflation and did kill inflation. Mm-hmm. So I think that's the most important determinant. What does the market think about the Fed? Now, right now, we were talking before the show, right now, the Fed funds futures is looking for 74 basis points, that's the average, 74 basis points decline in US rates by the end of the year. Mm-hmm. I'm not saying that's impossible, but I'm saying the market is acting on that assumption. I think the market's overly optimistic on that, to be honest. What we saw last month from the Fed was, as I put it, a pause, not a pivot. They have not pivoted, and it may be a little while before rates come down. But the gold market, the stock market is priced as though the Fed is they're priced as though we're not having a recession, and they're priced as though rates coming down basically 0.75 of a point before the end of the year. So I think in the immediate term, gold is vulnerable to a pullback. Mm-hmm. Now, I did say I ought to disclose, I said that 2 weeks ago, and it hasn't worked out so well so far. But, we were talking again, you look at Anglo Gold, for example, Anglo Gold, and I'm not picking on them, but it's gone from, under $17 in the middle of March to $27 today. That is an enormous move for a stock. And why has it moved? Did they come out with great results? Were their costs down? No. They had a very high short interest, and I suspect it's largely short interest short covering, which is the excuse everyone uses when a stock goes up and you don't know why. But in the case of Anglo, they had the highest short interest in several years. I suspect that has contributed certainly to the move, but it's not going to continue like that. And I think the market right now, you could look at the whole XAU. Let's see if I have it here. Yeah, I mean, the whole XAU has basically, since the beginning of March, the XAU has gone up by a multiple of what gold has, more than twice as much. I guess that's what you'd expect in a bull market. But my point is, I just think it's vulnerable right now. I think it's vulnerable. If the market shifts its analysis to, well, maybe the Fed's not going to lower rates as soon as we thought, maybe they are going to raise rates one more time, I think gold is vulnerable.
And again, we need to separate that's over the shorter term versus your longer term feeling on gold.
Oh, absolutely. And thank you for that. Yeah, I don't want anyone thinking I'm a bear. I'm just about as bullish on gold and gold stocks as anyone rational could possibly be. I just think, when you see gold go up over $200 in 1 month, and it goes up $200 in 1 month because of expectations that the Fed has pivoted, or you look at the XAU, which has gone up from 20%, a little more than that. I think you run the risk of a pullback. Mm-hmm. But longer term, I'm extremely positive. And I'm extremely positive because essentially the Fed, the ECB, the Bank of England, all of the other banks around the world, and we'll leave out Japan and China for the moment, but all of the other central banks around the world are really in an impossible situation. Now, it's an impossible situation of their own making, so I have no sympathy whatsoever for Jerome Powell and Janet Yellen and Ben Bernanke, who got us into this problem in the first place. But the truth of the matter is, they simply cannot kill inflation without causing a serious recession. And not only a recession, but probably, as they say, things breaking in the financial system. Mm-hmm. And I think they're going to try to get out of it. Last month, we had, with the 3 banks in the US and Credit Suisse, we had that first indication that aggressive interest rate hikes actually were going to have an effect. We had that first indication that major things were going to break. And we also had the reaction from the Fed and the Swiss National Bank and the Bank of England, which was to throw money at it. Mm-hmm. In basically 1 weekend, the Fed undid almost half of all of the QT, quantitative tightening, that they did in the last 12 months. In 1 weekend, half of it went. So I think what we're going to see in the near term going forward is the Fed is going to try to keep rates high, higher for longer is their mantra. They're going to try to keep rates high, but every time there's a problem, they'll just boost the money supply. And that's going to be a damaging thing for the economy, because we're going to have a sluggish economy, and we're going to have persistent inflation, stagflation. And in a stagflation, gold is the best performing asset, always has been. Mm-hmm.
So, Adrian, I've had a couple discussions, obviously, around the banking crisis, and there are some of the internal dynamics of how that capital injection, let's say, or that loan program works that are nuanced and we need to understand. But do you think on aggregate, like on balance, that ends up just being more dollars into the system and on balance undoes that QT that they ended up doing?
Yeah, no, on balance, absolutely. And the other thing that's critical, and people aren't talking about this, is the moral hazard that this creates. Remember, the Silicon Valley it wasn't that last interest rate hike of 0.25% that did for Silicon Valley. And you could say the problem wasn't really the Fed raising rates by 4.5% over a year. The problem was the Fed having excessively easy money for so long. So excessively easy money and ultra low interest rates created distortions in the economy, distortions of all types. It meant zombie companies didn't go out of business the way they should have gone out of business. And, Joseph Schumpeter, if you remember he talked about, creative destruction. You need that in the economy in order to get new companies with new ideas and better ways of building mousetraps to develop. You need older companies with old technologies and bad ways of doing things or old ways of doing things to go out of business. And ultra low interest rates prevented that. It meant companies borrowed much more money than they should have done. And they borrowed money. You saw companies borrowing money to pay dividends. You saw companies borrowing money to buy back stock. You shouldn't borrow money for these things. You should borrow money for capital investment. And it's not a coincidence. So we had ultra low interest rates. At the same time, we had a decline in the US, I'm talking now. You had a huge decline in capital investment. It's not a coincidence. And so the distortions that were created over 12 years have only just started to come to the surface. And again, to quote Warren Buffett, I don't like his politics, but he does have some good aphorisms. It's only when the tide goes out that you see who's swimming naked. And that's what we're seeing now. With the rates going up, you start to see who, in fact, has shaky balance sheets. Because if you can borrow at essentially zero, high yield was under 4. If you can borrow at very low rates, it's easy to disguise problems.
So what do you think is the path forward from the Fed here? You said that the stated policy is higher for longer, but if they combine that with throwing more money at the problem, essentially going back to QE, what does that create within the economy, the stagflationary environment?
Yeah, I think that creates a stagflationary environment because that doesn't get rid of inflation. So we have persistent inflation. But if the money is all going to financial institutions to solve the problems that financial institutions have, and at the same time, we've seen this in the last few years, and we're seeing it again now because of Silicon Valley and so on. If the banking regulators are telling banks to be more careful with their loans, risk managers at banks are, for a lot of different reasons, internal and external, banks will lend less money, which has a negative effect on the economy. Incidentally, that's one of the reasons I love the BDCs, because when the banks don't lend money to high-quality companies, those high-quality companies go to alternative sources of financing, which includes the BDCs. So recessions are great for the BDCs because they can upgrade the quality of their portfolio, but that's a different issue. So you see persistent inflation, but still a sluggish or declining economy, stagflation. And gold is if you look at studies, gold is far and away the best performing asset to hold during a stagflation. Gold stocks, other commodities, and smaller markets, equities are also good. The worst assets to hold are developed market stocks and developed market bonds.
Yeah, I was going to say, how about the bonds in that situation? Of course, I think it depends on the time duration as well in that case.
Sure. Well, sometimes the smaller markets and emerging markets, their bonds can actually do well because the dollar starts to decline. So for a US dollar based investor, you get a currency benefit from investing in smaller markets, and smaller markets I'm using the term smaller markets rather than emerging markets because, today, if you think of emerging markets, you're thinking of some pretty small, exotic, out of the way places. But if you use the term smaller markets, whether it's Brazil or Singapore, two totally different countries, of course, but not the big developed markets. They tend to do well. Both their economies tend to do well and their stock markets tend to do well in periods of inflation and in periods when the dollar is declining. So if that's what we expect over the next couple of years, which I do, I think some of these smaller markets will do very, very well indeed, especially since their stock markets have actually lagged considerably over the last 10 years. They've lagged a lot from the US and developed markets. And yet their finances, I'm painting with a very broad brush, of course, but the government finances tend to be much stronger. Now that's, they had a huge shock 20 years ago now, or 30 years ago, with the Asian crisis back in 1987. And when a lot of companies were earning revenue in, let's say the Malaysian ringgit, and all of the companies were borrowing money in US dollars, bad thing. You've always got to match your assets and your liabilities, whether it's currency, whether it's duration, whatever it is, they've got to be matched. And anyway, that's history now. But most of these countries learned their lesson back then, are in much, much stronger situation than they were. You look at a country like Singapore with very, very solid government finances, very low debt. So even if they have a recession, they can withstand it, and it tends to be a shorter and shallower recession.
Mm-hmm. Adrian, when you're bringing up the point that these economies are going to do better in an inflationary environment and when the dollar is coming down, does that also apply, again, painting with that broad brush, does that also apply to commodity producing countries like, let's say, Canada and Australia?
Well, that's the other issue. I was just going to say commodities are the huge differentiating factor, whether you're a commodity importer or a commodity exporter. For countries that are primarily commodity exporters, obviously the inflation helps commodity demand for commodities. Inflation helps. It's offset by a declining dollar because the dollar, because commodities are priced in dollars. So it's a little bit of a balance. Commodity importers are they benefit obviously from the inflation, and they benefit from having stronger currencies. If you have a stronger currency, it's easier, but foreign goods are cheaper for you, obviously. Mm-hmm. Yeah.
Interesting, Adrian. Well, that's pretty much run through all the list of a good amount of the questions that I have. One of the other things that I wanted to ask you is, and we did kind of touch on this, where do you think the consensus is currently wrong?
I think the consensus is wrong in still expecting a soft landing. Other than, Jerome Powell and people in the Eccles building, I don't think there's many people who expect no landing anymore. But the consensus seems to dismiss the prospect of a recession. Mm-hmm. That's number one. I think the market has been wrong and continues to be wrong in underestimating the willingness of the Fed to keep rates high to fight inflation. They will get a little bit of a respite as the headline inflation numbers come down over the next couple of months, which I think will happen. But they will make a mistake if they think that inflation, has been that they have a victory over inflation. So I think the market is underestimating Powell's willingness to cause a recession, and they're underestimating the risk of a recession. And lastly, most people, we talked about the consensus analysts on S&P earnings. Most professionals in the market today have only been around during periods of easy money and during periods when the Fed always came to the rescue. Mm-hmm. And I think, I may be wrong, but I think this Fed is willing to see the stock market decline meaningfully. This Fed is willing to see a recession. Financial crisis will be something different, but I think they're willing to see a slower economy. They're willing to see unemployment. In fact, they want unemployment to go up. They've said that. Mm-hmm. And they're willing to see a stock market decline before they panic. That's unlike 2018, 2016, 2014, 15, whenever it was, etc. Mm-hmm. So I think the market is underestimating that, both of those two things.
Mm-hmm. Don't fight the Fed has changed.
Yeah.
Excellent, Adrian. Well, of course, for anybody that would like to hear more from you, you're available at adriandayassetmanagement.com. Do you still write your newsletter?
Correct, I do. Yeah.
And that's available to anyone?
That's a subscription newsletter, but separate from the money management. You can global analyst at adrianday.com. Global analyst at adrianday.com. We'll get the newsletter.
Okay, perfect. Anywhere else to find you, Adrian?
If you just look me up at adrianday.com, you'll find it.
Perfect. Adrian, thanks so much for your time and your perspective today. Really appreciate it.
Well, thank you very much, Tom. I appreciate it. Hope we can do this again.
Absolutely.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.